What's up, guys? So today we're going to use the binomial interest rate tree model to value bonds with embedded options. So we're going to start off with a volatility assumption. And so just a preface, we're assuming that interest rates follow the 1-year rate follows a log normal random walk with standard deviation 0.15, and that's annual standard deviation. And so we'll see what the implications of that is later. So we're going to import the yield curve. And so this is just to specify the zero coupon yield curve of Government of Canada bonds. And so we're seeing here that we're getting our rates. Well, you can't see it now, but I got this from the Government Bank of Canada website. So I run that. Boom. And so here we have the yield to maturity zero coupon bonds. Here, this is the file that I got. It starts in 86 and it goes all the way to about 2 weeks ago. This is open source, so it's not the most recent. This is just for illustrative purposes, but we can see, this is our 3 month, 6 month, 9 month, 1 year, all the way to something like 30 years. All right, so these are effectively the spot rates that we're going to discount cash flows at. So a year 3 cash flow will be discounted at this rate, year 2 at this rate, etc. And we can use these to get our par curve. And so these are the yield to maturities of bonds that trade at par. And so what this means is if we have a coupon of this, a bond that has this coupon and matures in 5 years, well, it's going to trade at par. And now we can get our forward curve. And so these are the 1-year rates for different maturities. So the 1-year rate today is going to be the same as the yield to maturity on a 1-year bond. And again, the assumption here is these are annual paying bonds. And it's also going to be our spot rate. But then for our 2-year, this is the rate that we can lock in today following a no arbitrage rule. And what that means is, rather than investing at the 2-year spot rate, we can invest in the 1-year spot rate, and then reinvest again in 1 year at this rate, and we'll get this 2-year spot rate back again. And so we follow that methodology to get to all the other rates. So this is up to the 1-year rate in 4 years. And if you want to look at the code, feel free to pause the video and look at the code here. I'm using a numerical method, fsolve, to try a bunch of different yield to maturities essentially and see which yield to maturities when discounted, which coupons when discounted at the spot rates over here will give us a par value back, a market value of 100. And recall that if a bond trades at par, the yield to maturity equals the coupon. So we have this. Now we can start building our interest rate tree and calibrating using the government yield curve. And so here we can see explicitly the equation that I'm using to calculate the different possibilities of interest rates. And recall that we're assuming that the 1-year rate follows a log normal random walk. And so what that means is that the lower rate is equal to the upper rate divided by e to the power 2 sigma. And recall that we assumed sigma. We can infer sigma using historical interest rates, or we can look at the implied volatility in the derivatives market. So here again, we're using fsolve to see, we're using a backward induction methodology to see, okay, which rates will give us back the market value of our bonds that trade at par. And so this is explicitly for 2 years. Now this is the generalized version for years 3 to 5. And so here, feel free to pause the video and look at the code. like that. So we run, and now we get, so these rates are sort of the priced in probabilities of interest rates, the priced in likelihoods, assuming that rates follow a random walk. So this is the rate that you discount year one cash flows. In year two, at the beginning of year two, if rates go up, we discount them at this. If rates go down, we get those out of this. And recall that, just because it's low here doesn't mean that rates are going to low. Here we can see that priced into the current interest rate environment is an expectation of rising rates, because even the low rates in 1 year is higher than the 1 year rate today. So that's just an interesting implication here. We can see they go up again. But to make sure that we correctly calibrated our interest rate tree, what we can do is here, what I'm taking here is the yield to maturity of a 5-year government bond trading at par. And so I'm going to plug that as our coupon. This is our coupon. Our tenor is 5. We're going to talk about the spread later. But if we run this, we get our par value back again, which means that we correctly valued our interest rate tree. And so what these values, this is a present value today. In 1 year, this is a present value. In 1 year, this is the present value of rates go down. Or the rates are the higher of the likelihood or the lower of the two possibilities, etc. So in present value today, in 1 year, in 2 year, in 3 year, and in 4 years. And then in 5 years, it's just going to be the face value of the bond, assuming no default. So now we can use this information to get the value of a bond with any coupon, any tenor up to 5, and with the spread, as well as a put and a call option. And so the put, we're assuming that if the value of the bond dips below par, the investor will put. And if the value of if the bond is callable and the value goes above par, well, then it makes sense for the issuer to call the bond and then refinance now that the interest rates are more favorable. And so recall that if interest rates go down, then our bond will go up in price, and if it goes up enough above par, well, then it makes sense for the issuer to call. And so let's say we have a corporate bond with a 5% coupon, and it's a little bit risky, so we'll put in a spread of 500 basis points. Boom. So the bond will be valued at this today, and then these are all the, these are stochastic values. These are the probabilistic. Well, this is also probabilistic as well. All right, now we can put in so if we put a put, we'll see that, what does this mean? Oh, it makes sense to put the bond today to sell at par because, well, it's trading below par and it's not going to recover, assuming our current interest rate environment. Let's lower the spread to 400 basis points. Okay, now we can see that if rates rise high enough, these are the higher rates. Oh, we're anticipating a put of the bond. Now, let's say 450 beeps. Let's say it's a call. Well, it never exceeds par. So in that case, we're not anticipating a call of the bond. Let's lower our spread. Oh, see, we get called over here because the value goes above 100. And so I hope this outlines the no arbitrage construction of the binomial interest rate tree. with our log normality assumption of interest rates, and how we can use this binomial interest rate tree to value not just vanilla bonds, but now bonds with embedded options like puts and calls.